Hello, I'm going to start now, and I'll start by welcoming everybody to our presentation today on non-GAAP measures in the wake of COVID-19. I'm Laura Richmond. I'm counsel in the capital markets practice at Mayer Brown, and I'm based in our Chicago office. And with me today is Ryan Castillo, who's a partner in Mayer Brown's capital market practice, and he's based in New York. So let's start with slide 2, please. We have a full plate to get through in the next hour, starting with non-GAAP basics and SEC guidance, both with respect to non-GAAP financial measures and key performance indicators, as well as COVID-related non-GAAP measures. And we're also going to examine SEC comment letters and enforcement actions and roles of management and the audit committee, as well as effective disclosure controls. So let's advance to slide 4 and talk about what is a non-GAAP measure. As it sounds from its name, it is a financial measure, but it's not governed by generally accepted accounting principles in the United States. But it can be tricky to define things by what they're not. So this slide provides the basics of what it is. It's a numerical measure of historical or future performance, and it is going to either exclude or include or adjust amounts when you compare it to the most comparable GAAP measure. Now, operating measures and other financial measures and ratios or statistical measures won't be considered non-GAAP financial measures if they are exclusively calculated from financial measures calculated in accordance with GAAP and or operating or other measures that are not non-GAAP financial measures. So some of these would be EBIT. I'm still on slide 4. Earnings before interest and taxes, or EBITDA, such as earnings before interest, taxes, as well as carving out depreciation and amortization. Or maybe you have adjusted earnings or adjusted EBITDA that are removing various one-time, irregular, or non-recurring adjustments. Free cash flow is another example, typically calculated as cash flows from operating activities minus capital expenditures. So why use non-GAAP financial measures? Well, they can supplement financial statements and help companies tell their story. And they show management's view of core operations, for example, by eliminating non-recurrent charges that management believes are not indicative of ongoing performance. Slide 5. The SEC provides 2 sources of non-GAAP financial measure regulation. One is item 10E of Regulation SK, and that applies to non-GAAP financial measures that appear in SEC filings. You also have Regulation G, which applies to all public statements made by SEC reporting companies that contain non-GAAP financial measures. But this slide is talking about item 10E, and it specifies that the non-GAAP measure must be accompanied by a presentation of equal or greater prominence of the most directly comparable GAAP measure, along with a reconciliation to that measure. Slide 6. The filing must disclose the reasons that management believes the non-GAAP measure provides useful information to investors. And there also would have to be a statement disclosing if there are additional purposes, if material, for which management uses non-GAAP financial measure that's being disclosed. Item 10E also contains some express prohibitions on the calculations and presentations of non-GAAP financial measures. So, for example, it can't exclude a cash charge from liquidity measure except for EBIT or EBITDA. And you have to, when you're thinking in terms of a non-recurring or infrequent or unusual measure, you have a 2-year window backward and forward. And also don't use non-GAAP financial measures on the face of footnotes in financial statements or on the financial statements or on the face of pro formas. And when you name them, it's important because it can't have a title that is the same or similar to the non-GAAP measure. Slide 7, please. As I indicated a moment ago, Reg G applies to non-GAAP financial measures in public statements by SEC reporting companies, and that's whether or not they're in an SEC filing. So this means Reg G is going to govern press releases, investor presentations, conference calls, webcasts, etc. So like item 10E of SK, Reg G requires a presentation to the most directly comparable financial measure and a reconciliation of the differences between the non-GAAP and the comparable GAAP measure. But it also prohibits the non-GAAP financial measure when taken together with the accompanying information to contain an untrue statement of a material fact or to omit a statement that's necessary in order to make the presentation of the non-GAAP financial measure in light of the circumstances under which it's presented not misleading. Slide 8, please. Foreign private issuers don't have to comply with Reg G if their securities are listed or quoted on an exchange outside the U.S. And the non-GAAP financial measure is not derived from a U.S. GAAP measure, and they make the non-GAAP measure disclosure outside of the U.S. Slide 9. Foreign private issuers are also exempt from SK item 10E if they are using a non-GAAP financial measure in a Form 20F or a registration statement if the measure is required or expressly permitted by their local GAAP principles that they use in their primary financial statements, and it's included in the FBI's annual report or financial statements. Now keep in mind that Form 40F, which is the MJDS form used by Canadian issuers, isn't subject to either Regulation G or 10E. Now let's go to slide 11 and talk about compliance and disclosure interpretations. And the staff has issued a series of these CD&Is devoted to non-GAAP financial measures. And among other matters, these C&DIs provide guidance on what the staff considers to be misleading use of non-GAAP financial measures and what is considered unacceptable prominence of a non-GAAP financial measure, as well as guidance in specialized areas. Now, as this slide indicates, there are non-GAAP measures that the staff has concluded are inherently misleading. For example, a performance measure that excludes normal recurring expenses that are necessary to operate the business, or adjustments that aren't consistent with prior periods unless there's changes disclosed and the period and the reasons explained. Or if you do only the non-recurring charges and not when disclose non-recurring gains in the same period, and also a revenue measure that backs out the effect of GAAP revenue recognition. Slide 12, please. Prominence is another point that the staff has placed strong paramount importance on. And one of the things I want to emphasize from this slide is that the staff looks at your earnings releases as well as your SEC filings. And so, one issue of prominence is putting a reference to a non-GAAP measure in the bullet points, the captions at the head of the press release, and not giving the comparable GAAP measure. Or if you characterize, record non-GAAP earnings and don't mention that in GAAP there was another kind of characterization to be made. So if you're going to make a characterization, make it both ways and be very, very cautious about talking about record non-GAAP measures when the corresponding, the most directly relevant GAAP measure may have been negative. Let's move to slide 13. I want to point out that the SEC has some specialized CD&I. So, for example, this slide highlights forward-looking non-GAAP information, indicating that if you rely on the unreasonable efforts exception for a quantitative reconciliation without identifying the information that's unavailable and its probable significance, then you're giving more prominence to the non-GAAP measure, and that's not allowed. Slide 14, please. Similarly, there's guidance on tax effects as to when it might be acceptable to adjust for GAAP taxes, and noting the adjustments to arrive at the non-GAAP measure should not be presented net of tax. Next slide, please, 15. There are several CNDIs that relate to foreign private issuers. So, for example, this question 10601 clarifies what it means for a non-GAAP financial measure to be expressly permitted by the standard setter that's responsible for establishing the GAAP used in the company's primary financial statements and included in its filings. Slide 16, please. This question addresses how to incorporate portions of a furnished 6K into a Securities Act registration statement, noting that it can involve two separate 6Ks as an alternative, as long as that presentation is not misleading. Slide 17, I'll just quickly note these other two. One talks about regulation G in the context where a 6K permissibly, in accordance with the regulation, doesn't comply, but later it gets incorporated into a Securities Act registration statement other than an MJDS one. And in that situation, the company must comply with Regulation G. And on the other hand, if a Canadian company includes a non-GAAP financial measure in an annual report on 40F, it doesn't need to comply with either Reg G or 10E if the company files a non-MJDS Securities Act registration statement that incorporates the 40F. In that circumstance, the staff noted that the information included in the 40F isn't subject to Reg G or item 10E. Now, this is a lot of detail I went over quickly about staff guidance, and the purpose wasn't to, in effect, get you to remember all of these specialized interpretations, but really to emphasize that there are a number of helpful interpretations out there that might directly apply to your situation or might apply by analogy. So it is very useful to be aware of this resource and make use of it when you're trying to make decisions as to your non-GAAP presentation. So now let's move to slide 19 and talk more specifically about COVID non-GAAP measures. And to do that, I want to go back to last March when the staff issued CF Disclosure Guidance Topic 9, and that provided guidance on disclosure and other security law obligations for companies to consider with respect to the COVID-19. And it recognized that it can be difficult to assess or predict with precision the broad effects of COVID-19 and its actual impact. And I think that is the case even now, as we're almost a year into the pandemic in the U.S. when the shutdowns, et cetera, started. And Topic 19 observed that the effects of what management expects future impact to be is evolving, and it recognized that if companies use non-GAAP financial measures and performance metrics, they should also be doing so, they should be doing so, if they're going to use it, it has to be for the purpose of sharing with investors how management and the board are analyzing the current and potential impact of COVID-19 on the financial statements. You can't be using non-GAAP financial measures to adjust for COVID-19 for the purpose of presenting a rosier or more favorable view of the company. Slide 20, please. The guidance provides that if a GAAP financial measure is not available at the time of an earnings release, because the COVID-related adjustments require additional information and analysis, the division won't object to companies reconciling to a non-GAAP financial measure to preliminary GAAP results that either include provisional amounts based on a reasonable estimate or a range of reasonably estimable GAAP results. The non-GAAP financial measure should not be disclosed more prominently than the comparable GAAP measure or range of measures. But that particular guidance and no action position only applies to the earnings release. For SEC filings such as a 10K or a 10Q, where GAAP financial statements are required, by that filing, companies would have to reconcile any non-GAAP financial measure to the actual GAAP results and not to provisional amounts or a range of estimates. Topic 19 specified that in circumstances where a company presents non-GAAP financial measures that are reconciled to provisional amounts or an estimated range, they should include only non-GAAP financial measures that it's actually using to report financial results to the board. So when reconciling the non-GAAP financial measures, companies should explain to the extent practicable why the line item or accounting is not complete and what additional information or analysis may be needed. I'll just mention quickly that CorpFin did supplement topic 9 guidance with 9A, which deals a little bit more expressly with MD&A topics such as operating results and liquidity. But the guidance that they've been giving on COVID is principle-based. So it's not stuck in time at the beginning of the pandemic. It's still applicable now. Slide 21. So you need to assess the facts to determine if a COVID adjustment is appropriate to present as a non-GAAP adjustment. So consider, as I said a moment ago, we're about a year out. We've got a year of experience, and that experience may have demonstrated that a COVID adjustment that initially was thought to be non-recurring has actually become part of ongoing business operational expenses. And if it's not recurring, if it is a recurring item, then you'll need to change your presentation. You also need to determine if it's in fact appropriate to describe an adjustment as attributable to COVID, and consider whether you have a basis for presenting the adjustment as an actual amount, or do you only have a hypothetical amount that you're disclosing. In other words, can you quantify the adjustment? And is it incremental to normal operations? You also should consider whether the COVID non-GAAP adjustments give the full picture of the pandemic's impact on the company. You might have to have additional discussion in the MD&A or a business description to provide further context. But it's especially important to be consistent between periods to explain what the adjustment is and exactly what is being adjusted to reflect COVID, and what is the management objective in presenting the adjustments. Why is it useful to consider? You also need to keep the basics in mind that we've just gone over in terms of be sure you have the most directly comparable GAAP measure, and keep in mind what the guidance generally talks about as a measure that might be inherently misleading, and consider whether your disclosure controls and procedures are sufficient as they are now, or if you need to expand it in some way to cover the COVID adjustments. Slide 22, please. I wanted to just give some examples of what might be a COVID-19 non-GAAP measure. You might have an adjustment for changes to employee compensation, whether that be hazard pay or severance pay, or any kind of cost containment efforts because you've reduced the workforce. You may have sanitizing and disinfecting costs, so maybe that is becoming recurring. There's PPE costs. Some companies have restructuring charges. Some companies have had lease or contract termination costs or facility costs when they're shut down. So be specific. COVID-19 has touched so many different aspects of a company's business, and the types of impact may vary across companies, even in the same industry. So simply saying a COVID adjustment isn't enough. So now let's go to slide 24 and segue over to key performance indicators. And the SEC provided guidance in the MD&A context about a year ago. KPIs raised a lot of the issues that were similar to non-GAAP, and so it makes sense to discuss them in the non-GAAP context, even though they might not technically fall within the definition of a non-GAAP financial measure. So the guidance I referred to a second ago describes how the MD&A rules apply to key performance indicators and metrics. And it notes that the SK rules not only require the discussion of specific kinds of topics like liquidity and capital resources and results of operations, but you also should be having a discussion of other information that the company believes to be necessary to understanding the financial conditions and the changes in financial condition and results of operation. And that discussion, to the extent material, would include statistical information, for example, that would enhance a reader's understanding of these measures. Now, this guidance on KPIs came out before COVID-19 reached the pandemic levels in the United States, but it's principle-based, and it's applicable to KPIs used in COVID-19 disclosures, so it really is very topical to our current topic. And in the disclosure guidance on COVID-19, the staff expressly reminded companies of their obligations with respect to the non-GAAP measures, at the same time mentioning that the KPI guidance was relevant, highlighting the close relationship between the principles of those two items. So if you're giving effect, if you're using KPIs to give effect to the pandemic, keep in mind both the KPI and the COVID-19 guidance. Slide 25, please. The guidance observed that companies disclose both financial and non-financial measures to describe their business, and oftentimes you've got company-specific or industry-specific measures, and they could be external or they could be internal, it could be macroeconomic, it could be a combination of those kinds of measures. Slide 26. The KPI guidance reminds companies that when they include metrics like this in the MD&A, they need to include further material information as may be necessary so the metric is not misleading. Now, according to that guidance, a company must consider whether there's an existing regulatory framework. It could be GAAP or Reg G or Item 10 that applies in the context of the metric it uses, and then assess whether additional information might be necessary to provide adequate context so that the investor will understand the measure. Let's take a look at slide 27, which gives examples of measures such as same-store sales, active customers, number of account holders affected by a data breach, employee turnover. These are some of the ones that are specifically highlighted by the guidance. KPIs, because they're not GAAP measures, they're often highly customized. And as a result, it makes sense for this list to be expressly a non-exclusive list. You need to think through whether you're using metrics that fall within the guidance, whether or not they appear in this grid. Slide 28. So based on the circumstances, the SEC generally expects a key performance indicator to be accompanied by a clear definition of the metric, how it's calculated, what the assumptions are, the estimates that you're using, and why it provides useful information to investors, and how, in fact, does management use it in managing or monitoring the business. According to the KPI guidance, a company needs to consider whether there are underlying estimates or assumptions for the calculation that need to be disclosed in order for the metric not to be materially misleading. Often a company uses key performance indicators in investor presentations, including an earnings release, and you need to provide the same level of review in relation to those types of presentation as you would in the MD&A. And another thing to keep in mind, if you're going to use KPIs in the earnings release or other presentations, you may need to discuss them in the MD&A because it's likely to be expected. Slide 29. So if a company changes the way it calculates or presents a metric from one period to another, if it's material, it needs to consider disclosing the differences in the way the calculation is made or presented from prior periods and the reason for the change and the effects of the change on the amounts or other information presented, and other differences in methodology that could be relevant to understanding the performance. And important to note that depending on the significance following a change in methodology or presentation, companies might find it necessary to recast prior metrics to conform to the current presentation and place the current disclosure in the appropriate context. Slide 30. So I'll finish up by talking about disclosure controls in the KPI guidance context, because if indicators and metrics are material to an investment decision or to a voting decision, and they are derived from company information, the company needs to consider whether it has effective controls in place to process the information, especially if they're derived from their own information. You should be reviewing your company's disclosure controls and procedures to be sure that they're effective with respect to the calculation of the key performance indicators and metrics. The review should also include a discussion with the audit committee, because the audit committee should really be understanding the key performance indicators that are used and what their purpose is, and whether they're well understood and well defined, and is the methodology for their calculation understood, and have there been significant changes in the calculation methodology. If a metric is customized, you really need to document the way the calculation is done so that over time, others within the organization who are calculating the KPI for disclosure purposes are doing it consistently, so you can identify if there's a change that requires disclosure. So with that, Ryan, I'm going to turn the program over to you now.
Thanks, Laura. So now we look at recent SEC comment letters on non-GAAP measures, KPIs, and COVID-19 disclosures. On non-GAAP, following the 2016 release of the CNDIs, CorpFin signaled they will focus on non-GAAP measures. The staff said that there will be an uptick in comments, and they asked companies to self-correct their non-GAAP disclosures. And the staff has followed through. In 2017, non-GAAP measures was the #1 topic in SEC comment letters. An audit analytics report showed 1 out of 3 comment letters in 2017 involved a non-GAAP comment. Now, fast forward from 2018 to the present, comments have decreased, but non-GAAP measures remain an important area of focus for the SEC. And we expect that to be the case, considering that 94% of the S&P 500 use at least one non-GAAP measure. The most common staff comments can be grouped into 4 broad categories: the need to reconcile to the most directly comparable GAAP measure, avoiding undue prominence and potentially misleading non-GAAP, and explaining the reasons and usefulness of non-GAAP. Now, how about SEC comments on COVID-19? Well, from 2020 to the present, the bulk of SEC comments focused on scrutinizing how companies disclose the effects and risks of COVID on their business, financial condition, and operations. Filers were asked to detail and quantify the impact of COVID on results, revenue, and liquidity, enhance risk factors, and identify trends and uncertainties in their MD&As. So the next few slides show some examples of these comments. So in box 1, the staff wanted expanded disclosures on the specific impacts of COVID on operations and metrics. They asked companies to quantify the effects of COVID on their results, funding sources, liquidity, and financial covenants. In box 2, they asked for separate and detailed COVID risk factors. On the next slide, the staff asked filers to discuss known trends and uncertainties that have had or will likely have a material impact on revenue, business KPIs, and results. So those are samples of the SEC comments on COVID-19 disclosures in general. Now, how about SEC comments on COVID-19 related adjustments made to non-GAAP measures? From 2020 to the present, there were not a lot of comments on COVID-19 non-GAAP measures, but some registrants were asked specifically to explain the nature of COVID-related adjustments. Let's take a closer look at 2 cases. Case 1 involved a real estate investment trust that operates detention facilities and prisons. Its business was severely impacted by the pandemic. In its September 2020 10Q, it reconciled GAAP net income to the non-GAAP measure normalized funds from operations, or FFO. And they excluded the line item that they called expenses associated with COVID-19, seen here in yellow on this illustration. Corpfin then commented, "Please explain the nature of expenses associated with COVID that you excluded from normalized FFO." The company responded that based on guidance from leading audit firms and law firms, they believe exclusion of COVID-19 related expenses is proper if the expenses are 1, directly attributable to COVID, 2, incremental to charges incurred prior to the pandemic and are not expected to recur after the pandemic, and 3, the expenses are clearly separable from normal operations. They then proceeded to itemize the components of the COVID line item expense, as you can see here, including hazard pay for frontline workers, costs for procuring PPEs like masks, face shields, and COVID tests. They then showed how each item satisfied the guidance. For example, on this slide, they said that the PPEs were an incremental expense to buy supplies to protect the staff. They incurred incremental costs to provide disposable products such as trays and styrofoam cups, utensils, to comply with social distancing and prevent congregations in the cafeteria. So they argue that the expenses were directly attributable to COVID, incremental, not expected to be recurring once the pandemic is over, and separable from normal day-to-day operations. Corfin seemed to be satisfied with the explanation, and that was the end of the inquiry. Case 2. Case 2 was a computer chip manufacturer. it had to close manufacturing sites because of shelter-in-place restrictions or orders issued by local governments. In its 2020 Q2 earnings release, it included an adjustment for COVID-19 shelter-in-place restrictions on manufacturing activities in its reconciliation of non-GAAP operating income. So on this slide, that's the third line item over here. CorpFin commented, please clarify what you mean by this adjustment. How did you quantify this? And the company responded that because of the shelter-in-place restrictions, substantially all manufacturing sites were impacted and were not operating at normal levels. They quantified the 3 million non-GAAP adjustment as accumulated fixed overhead costs for the period, factored by a percentage of lost production days. They explained that it had never incurred costs related to government restrictions on employee movements before, and they do not expect to incur these costs for the next 2 years after the pandemic ends. Then they argue that the costs could be objectively quantified and are separate from normal operational costs. And the staff had no further comments. So those are examples of COVID-related non-GAAP adjustments and SEC comment letters. Now let's go to the most common non-GAAP comments issued to companies up to the present. On slide 42, you see a snapshot of the most common non-GAAP comments issued to companies. In the top row, you have the 4 general or broad buckets that we talked about earlier: reconciliation to GAAP, undue prominence, misleading measures, reasons, and usefulness. And under each general bucket, we have related subcategories under. Let's talk about them. The first general bucket is reconciling non-GAAP to the most directly comparable GAAP measure. This includes the case of no reconciliation, i.e., the company used a non-GAAP measure in its disclosures, but then failed to identify or label the measure as non-GAAP. Looking at a few SEC comment letters, in bullet 1, the company presented adjusted EBITDA, a non-GAAP measure, in its earning release, but it did not show the required GAAP reconciliation. In bullet 3, the company used a measure, but it did not label or identify it as a non-GAAP. So here there was no reconciliation, and the cause of that mistake really was a failure to identify the measure used as a non-GAAP measure to begin with. In other cases, filers were reconciling non-GAAP to the wrong GAAP measure. And here, 2 of the most cited non-GAAP measures are EBITDA and free cash flow. On EBITDA, CorpFin reminds us that if EBITDA is used as a performance measure, it should be reconciled to net income, not operating income. So that's what the first and the third bullets here say. On free cash flow, CorpFin reminds us that free cash flow is typically calculated as cash flows from operations less capital expenditures. The staff presumes that free cash flow is a liquidity measure, and so it should be reconciled to operating cash flow. Moving now to the second general bucket, the most directly comparable GAAP measure must be presented with equal or greater prominence than the non-GAAP measure. If you recall, the CNDIs have a list of examples focusing on undue prominence, and that includes not presenting the GAAP measure or GAAP discussion at all. The examples on this slide show the sin of omission. Companies highlight and discuss their non-GAAP measures like adjusted EBITDA or adjusted EPS, but then they leave out any mention of net income or adjusted EPS or GAAP EPS, the comparable GAAP measures. Staff says you can't do that. In other cases, the companies were showing GAAP measures, but the non-GAAP are presented with greater prominence than GAAP. So undue prominence results if the non-GAAP measure is presented ahead of GAAP, or the format, style, or presentation of the disclosures emphasize non-GAAP over GAAP. So for example, in the first 3 bullets on these slides, the non-GAAP measures precede or are located before GAAP. In the 4th bullet, the formatting was a problem, thus causing undue prominence. Another example of undue prominence is when companies present a full income statement of non-GAAP measures. CorpFin says you shouldn't do that. That's undue prominence. Okay, the third general bucket is potentially misleading non-GAAP measures. For example, you cannot use titles of non-GAAP measures that are confusingly similar to GAAP measures. So in bullet 2, when a company uses the term operating cash flow as a non-GAAP measure, the staff called that out, saying that term is the same as or confusingly similar to net cash flow by operating activities, which in turn was the GAAP measure. Bullet 4 deals with EBITDA. EBITDA means earnings before interest, taxes, depreciation, and amortization. That's the common accepted definition of EBITDA and the definition in an Exchange Act release. So if you use a measure and call it EBITDA, then investors will think you mean the common definition of EBITDA. But if you are adding additional adjustments to EBITDA or your measure differs from EBITDA as commonly understood, then the staff says call it something else like adjusted EBITDA. Comment letters also focus on the nature and frequency of adjustments made. And if you remember, presenting a performance measure that excludes normal recurring cash operating expenses necessary to operate a business could be misleading. And we have Regulation SK that prohibits adjustments that eliminate or smooth items labeled as non-recurring, infrequent, or unusual when the nature of the charge is it is reasonably likely to recur within 2 years, or there was a similar charge within the prior 2 years. In the examples on this slide, the staff asked companies to explain why they claim various adjustments, such as transition costs and advisory fees, are as non-recurring or unusual, when in fact these adjustments are showing up regularly and frequently and in multiple periods in their filings. Non-GAAP measures that substitute GAAP with individually tailored revenue recognition and measurement methods could violate Regulation G for being misleading. There is SEC guidance that presenting a non-GAAP performance measure adjusted to accelerate revenue, recognized ratably over time as though it earned revenue when customers are billed could be misleading. And whether something is an individually tailored measure involves a fact-specific analysis, so it's better to involve your accountants when you make that determination. Now, speaking of individually tailored measures, the next few slides are relevant to commercial mortgage REITs who use the non-GAAP measure core earnings, which is quite common in the REIT industry. So what happened? From June to November 2020, so last year, the staff issued letters to 2 mortgage REITs that core earnings should not exclude the unrealized portion of provisions for credit losses. The staff said that's an individually tailored measure and may be misleading. So in this box, in slide 51, you see 3 rounds of staff comments received by REIT number 1 from June to October 2020. And ultimately, the response from the filer, from the company, was that while we respectfully disagree with the staff's position, we will comply and refrain from making an adjustment when we present core earnings in the future. Let's dig a little deeper. So by way of background, core earnings is a non-GAAP measure traditionally used by REITs, and it's generally calculated as GAAP net income adjusted to exclude certain items such as unrealized provisions for credit losses. So the adjustment is not new. The measure aims to depict current performance by excluding unrealized items, as these involve significant estimates or judgments that may or may not happen in the future. And since REITs are required to distribute 90% of taxable income to shareholders, core earnings, the measure, has been widely used by analysts and investors to predict the ability of REITs to cover dividends. But where was the SEC coming from? Effective January 1, 2020, last year, the new CECL, the current expected credit loss standard, came into effect. And that required the use of an expected loss credit model for estimating future credit losses of loans instead of incurred losses. That now becomes part of the GAAP net income calculation. But then the adoption of the new CECL standard at the start of 2020, combined with the COVID impact, resulted in significant volatility in net income amounts for many companies due to the impact of the pandemic on loan loss assumptions. So because of this, expected losses soared. So what filers did was they began to exclude the CECL reserves in their non-GAAP measures. And Corfin said, wait a minute, we object to that because those adjustments could make the measures potentially misleading. So last November, REIT number 2 received the same comment from CorpFin. Don't adjust core earnings to exclude the unrealized portion of the provision for credit losses. And this time around, the company, along with the National Association of REITs, or NAREIT, engaged in discussions and made their case with CorpFin. And the outcome, as reported by the law firm to the REIT number 2, was that now CorpFin would not object to the use of core earnings as long as the measure is renamed, for example, distributable earnings, and the measure is accompanied by enhanced disclosure of its usefulness as an indicator of REIT dividends. So as a result of this, we understand a lot of commercial mortgage REITs will now be renaming core earnings to distributable earnings and providing the expanded disclosures. Okay, the next few slides talk about SEC reminders for companies to elaborate on the reasons for using non-GAAP and why they believe they are useful to investors. So you have the usual reminders from the SEC. Avoid boilerplate language, clarify when you are using a non-GAAP measure as a performance measure or as a liquidity measure. Now, with respect to KPIs, the staff asks companies to identify and label metrics used as KPIs, elaborate how management uses them, and explain their usefulness to investors. In bullet 2, the filer was asked to identify and define net revenue per client and explain why management was using the metric. In bullet 3, the company was asked to define the term customers for specific products and disclose the numbers for the comparable period. Okay, now let's talk about enforcement actions on COVID disclosures, non-GAAP measures, and KPIs. Let's start with a recent case about material misstatements on COVID disclosures. So company C as in cake, made statements in 8 key press releases in March and April last year that its restaurants were operating sustainably during the COVID-19 pandemic. The company said they quickly pivoted to an off-premises operating model, i.e. delivery and to-go food orders, and were operating sustainably under the model. So those were the public disclosures. But then, behind the scenes, the picture was much different. Internal documents showed that the company was losing about $6 million in cash per week, and they had only 16 weeks of cash left. A few days before they filed the 8K press release on March 18, the company actually sent letters to landlords that it will not pay April rent because, quote, of the severe decrease in restaurant traffic that severely decreased our cash flow and inflicted a tremendous financial blow to our business. The company around the same time was also approaching lenders and PE funds to raise $100 million in financing. The SEC said those press release statements were materially false and misleading. It ordered the company to pay $125,000 in civil penalty and to cease further violations. And here we have a reminder from Ms. Avakian of the Enforcement Division. She says, the Enforcement Division and the Coronavirus Steering Committee will scrutinize COVID-related disclosures to ensure investors receive accurate and timely information. Now, the next enforcement action is a case of undue prominence. Company A presented adjusted EBITDA in the headline and highlight sections of its 2017 year-end and 2018 Q1 earnings releases. But it did not mention or discuss the GAAP financial measures of net income or loss in those sections, but only the non-GAAP, the GAAP measures were only discussed several paragraphs later in those press releases. The SEC found a company violated item 10E of Reg S-K when it failed to present the comparable GAAP measure with equal or greater prominence. It ordered the company to pay a $100,000 penalty. Case number 3. This is a case of accounting fraud and manipulation by executives of a non-GAAP measure that was important to analysts and investors, namely same property net operating income or SPNOI. The company made improper adjustments to make it appear that it was meeting quarterly earnings targets. It lowered the prior year's SPNOI to make the current quarter's growth rate appear higher. It employed improper accounting tactics, such as the timing of revenue recognition. The SEC found the company violated Regulation G and filed false and misleading financial statements. It ordered the company to pay a $7 million penalty. A parallel criminal action alleging securities fraud was pursued by the Department of Justice. The last example is a case of manipulating key performance metrics. The SEC charged Company C and its CEO with engaging in a fraudulent scheme to overstate revenue and making false, misleading statements about key KPIs. The company manipulated the metrics total number of customers, net new customers added, and its flagship product revenue. The SEC ordered the company to pay $5 million in penalty. The CEO paid $700,000, disgorged $2 million in profits, and was barred from servicing in a public company for the next 10 years. So those are examples of enforcement actions that we have seen in the recent maybe 2 or 3 years from the SEC. Finally, let's talk about the roles of the audit committee and management. Since 2016, SEC staff members have emphasized the importance of establishing effective disclosure controls and procedures on the use of non-GAAP measures and KPIs. They also highlighted specifically the important critical gatekeeper role the audit committee plays in ensuring credible, reliable financial reporting. On the next slide, we have a 2019 joint statement from the then SEC Chair, Chief Accountant, and CorpFin Director, and SEC Chair, that it is important for the Audit Committee to understand whether, how, and why management uses non-GAAP measures and performance metrics, and how those measures are used in addition to GAAP and financial reporting and internal decision-making. The Center for Audit Quality, which is a nonprofit public policy group affiliated with the American Institute of CPAs, or ACPA, has also issued a roadmap for audit committees on non-GAAP measures on how to deal with them. They say that the audit committee can act as a bridge between management and investors, assess reasons for presenting non-GAAP, and evaluate the sufficiency of disclosures. And the NonGAP Roadmap that they laid out has 3 parts: identifying key discussion topics with management, counsel, and external auditors, understand the external auditor's role in non-GAAP measures, and 3, adopt leading practices to support presentation of highly qualified non-GAAP measures. And here you have some examples of several questions or items to consider when they do go in those 3-step analysis of their roadmap. Now, in 2020, the CAQ came out again with another publication, and they suggested that in executing the oversight of the financial reporting process, the audit committee can consider the questions on this slide. For example, ask the following question: does the company have an internal policy for determining how non-GAAP measures and KPIs are generated, calculated, and presented? What impact does economic volatility or other uncertainties, such as COVID-19, have on non-GAAP? Are related adjustments appropriate and expected to be non-recurring? On this slide, you also have additional questions to consider, including whether the audit committee has responded to challenges of audit teams working from home. Have they responded to changes to audit procedures or to the company's accounting policies? Any challenges relating to the company's control environment? Has the committee vetted on non-GAAP COVID-19 adjustments, impairments, changes to estimates, or to policies requiring judgments? Okay, the next few slides, we have included a few practical tips for compliance. Companies should revisit the updated SEC guidance and their approach to the use and disclosure of non-GAAP measures, KPIs, and COVID-19 disclosures. So understand the rules and learn from SEC comments and guidance. Involve the disclosure committee and management. Formalize and strengthen audit committee roles and oversight functions. When you have non-GAAP measures or metrics in your disclosure, ask the basic questions. Why are you using a non-GAAP measure or KPI? And how is it useful to investors? Is the non-GAAP measure or KPI clearly defined? Is it clearly disclosed? Are you giving non-GAAP measures no greater prominence as required? Are your explanations of how you're using non-GAAP measures accurate and complete and not boilerplate? Are there appropriate controls over the calculation of non-GAAP measures? Are changes in methodologies or calculations sufficiently explained and disclosed? On the next slide, some other practical reminders. Ensure that each non-GAAP financial measure is accurately defined, described, and captioned, and reconciled to the most directly comparable GAAP measure. Management should monitor the use of non-GAAP measures by their peers. Ensure that the nature of adjustments to arrive at non-GAAP measures has a reasonable basis and is customary among your peers. Avoid cherry picking, avoid individually tailored accounting measures. You also have that reminder that because Regulation G applies to all public disclosures, orally or written, then companies must take a closer look at how and when they present measures in press releases, webcasts, investor presentations, earning releases, conference calls, and other disclosures. And at the end of the day, to summarize, non-GAAP measures and KPIs can be an important tool for companies to tell their own stories, convey their information to investors that companies believe to be relevant, meaningful, and useful in understanding performance, financial position, and liquidity. At the same time, as we've seen in a number of the enforcement actions that we talked about today, we've seen that the use of non-GAAP measures is also prone to misuse and abuse. In certain occasions, they can become tools to confuse investors, distort the truth, conceal, or inflate actual performance, and worse, even perpetuate outright fraud. At the end of the day, non-GAAP measures should merely supplement and not substitute GAAP measures. The SEC always reminds people to remember that basic notion. Non-GAAP measures should merely supplement and not substitute GAAP measures. Management should understand and articulate the reasons for using them in SEC disclosures and take steps to ensure that non-GAAP measures are not only consistent, transparent, and credible, but at the end of the day, they are neither misleading nor prohibited by the SEC rules. I think that's about all the time we have for today. Thank you for joining us in today's webinar. Thanks, everyone. Please stay safe and take care.